Imagine this. You're at the start of a marathon. You see all the competitors warming up, they're stretching, getting their last little shakeouts in. The gun goes off, and everybody takes off running. Except, no, everybody doesn't take off running. So naturally, you're a little bit curious about this. You go up to the people and you ask them, "Sir, ma'am, why are you not running? Don't you know that you have a long way to go? Don't you know that there is a long ways between you and the finish line? Don't you know that you have 26.22 miles to run? 26.22 miles, that's 338,442 feet. The average stride for a human being is 30 inches or 2.5 feet. That means you have 55,377 steps between you and the end of the road. Don't you think you should start running?" And this person, looking very fearful, they look you back in the eyes and they say, "I hear that the road is a little bit icy, so I'm just gonna wait it out." And naturally you think, well, shouldn't you maybe start getting ahead of these people that are also standing next to you fearfully on the starting line? I mean, isn't this a good chance to put a good gap on the competition that's not even running in the race? I mean, there's a difference between, the world-class athletes, but I mean, at least run, at least run in the race. That's what we're going to be talking about today, is fear and not getting started. So for most of us that are younger, we've got a long ways to go between us and financial independence. And I like using all those numbers for how long it is between the starting blocks in a marathon, because it's almost like that one song. We all remember that one song, that "How do you measure a year?" I'll never sing again. Well, just this once, because I'm trying to teach you guys, how do you measure your investing career? And that, how you measure that is, once your expenses are less than what you're making through passive income, you reach financial independence. So let's get into the numbers. All right, so somehow I managed not to break my camera lens, so let's get into these numbers. What I am looking at is the dividends. I'm looking at the dividends and what I can get paid out. I'm looking at how safe those dividends are. So let's go ahead and just pull up the screen and we will pull up what exactly I am looking at, and 6 companies that I'm looking at that look pretty good right here. There's a little bit of risk involved with all of these and all investing, but I'll tell you why I'm doing what I'm doing. I'm never going to tell you guys what to do. I had a friend come up to me and ask me, what should I be buying? And I'm not going to tell you what to buy. I'm going to tell you why I'm buying what I'm buying. So hopefully you guys like this and get some value out of it. If you do, make sure you hit the thumbs up button. It really helps support the channel and helps the channel grow. So let's get into this. Stock number 1 is AbbVie. AbbVie currently pays a $4.72 dividend. They had EPS of $8.94. And let me just clarify what EPS is. It's basically the earnings of the entire company, or profits, divided by the shares outstanding, or basically how many stocks there are of the company. Anyways, moving on to the next thing that I look for as far as the dividend safety, and that is the payout ratio. Their payout ratio is about 53%, or in other words, of their profits, they pay out about 53% of it in the form of dividends to their shareholders. A lot of times what you'll see in the market is you'll see this company that has this huge dividend yield. Let's say they're yielding, 12%. And the market is pricing it that way sometimes because they know that the dividend is going to get cut. The dividend is subject to cut. For instance, we just saw Boeing being priced at a pretty high dividend yield based on its current dividend, but then you see that dividend get cut. And that's just based off looking at earnings, you're looking at balance sheets, you're looking at their cash flows, and you're looking at, does this company have the capacity to continue paying this dividend? That's what we look at most heavily when we talk about, can the company keep on paying its dividend? Do they have the earnings to support the dividend? For me to reach financial independence, I would need $31,000 in residual income. And for me to achieve that through AbbVie, I would need to buy 6,509 shares. This would cost me $447,923.73 at the current price of $68.82. Looking at the tax rates on qualified dividends, we get a little bit of insight into why the rich are getting richer, because they are paying less taxes on their income. From $0 to $39,375 in dividends from qualified dividends, you're going to pay $0 in taxes. $39,376 to $434,550, you're going to pay 15% tax on those qualified dividends, and anything above that, you're going to pay 20% tax on those dividends. So in other words, for me to reach financial independence, I don't necessarily need to pay any taxes based on this. If they're all qualified dividends, I don't need to pay any taxes on those dividends just because I wouldn't be making enough in dividends. As you can see down there, non-qualified dividends are taxed as ordinary income according to federal income tax bracket. Next company is McDonald's, ticker symbol MCD. They pay out a $4.64 dividend. Their EPS last year was $7.88. They have a 58.9% payout ratio, which is a decent payout ratio. They've got a decent balance sheet, and in order for me to retire off of just McDonald's stock, which obviously diversify your investments, don't just buy McDonald's stock, but I would need to buy 6,682 shares. This would cost me $992,210.18. So in other words, if I had that amount of money and I put it in the market today at this current market price, I would be able to retire early and I would have financial independence today. Now, the price could get slashed in half on the share price, but if I'm retired and I have financial independence, I really don't think I would care. That is the price of your freedom right there. Like, would you really care if I just said I was going to give you $31,000 per year and that's how much you need to live? Would you care if some random number on the screen went down? You probably wouldn't care. You'd probably care about what you're going to do with all that money that you're being paid. So why would you treat it any different at a lower scale? Just because it's not bringing you to the front doorstep of financial independence, it's bringing you closer. So that's what really matters. And that's what gives the shares value in the first place, is the underlying business, the cash that they pay out, the share buybacks, and the profits. Next stock is AT&T, ticker symbol T. They pay out an annual dividend of $2.08. Their EPS for 2019 was $1.89, a 33% EPS decline from 2018. This is due to bad deals that they made. In general, I feel like they have the ability to bounce back from this, and I'm not too worried about it. Their legacy business produces a lot of cash flow from them. They made some bad, Time Warner acquisition was a bad deal. Moving forward, I've listened to their earnings calls. I've looked into their 10K, 10Q, and I like what they have going on moving forward. I'm not going to go too deep into these individual stocks until I start deploying more money into the market, but this situation has left them at a 110% payout ratio based off of their trailing earnings. But I think that they'll be able to recover from this, and moving forward with 5G and all of their business ventures that they're going into, I think this is going to be a good purchase at these prices. In order for me to retire off of just AT&T shares, I would have to buy 14,904 shares. This would cost me $442,018.80, and I would be able to generate that $31,000 of passive income that I need to retire. Moving on to the next company. Next company is Altria, or ticker symbol MO. They pay out a dividend of $3.36 annualized. Their EPS last year was negative 70 cents due to their Juul write-down and just things that are kind of one-off things. Funny story, let me just tell you guys a funny story. People are not going to start smoking cigarettes. How do I know that? Even though we're going through this coronavirus catastrophe, we're going through, all these people are very scared out there, scared of death. People are still not scared of cigarette death. People are still not scared of the health effects of cigarettes. Like, I literally saw somebody who was wearing medical gloves, a surgical mask, and they were smoking a cigarette. So it doesn't matter what type of things you do to threaten people's health with cigarettes. It doesn't matter what the environment is. If people are running out of money, they're going to smoke those cigarettes. So I'm not too worried about that business line going away. I'm willing to put a little bit of money in there. In order for me to retire off of just Altria shares, I would have to buy 9,227 shares. This would cost me $316,301.56, and it would generate that $31,000. Moving on, the next company is Cisco, or ticker symbol CSCO. This is a telecommunications company. They pay out a dividend of $1.44. Their EPS for last year was $2.57, giving them a payout ratio of 56%. In order for me to retire off of Cisco shares, I would have to buy 21,528 shares. This would cost me $766,396.80, and I would be able to retire that day. Last company of the bunch is IBM, ticker symbol IBM. They pay out a dividend of $6.48 per share. Their earnings per share for 2019 was $10.56, giving them a 61% payout ratio. In order for me to retire off of just IBM shares, I would have to buy 4,784 shares. This would cost me $456,341.05. and I would be able to retire that day off of IBM shares. Now, I don't think any of these companies are going away. I don't think that this will not pass. So if I had that money, those amounts that I said, I would definitely be willing to reach financial independence today. So that's the way that I'm viewing it. I'm trying to view these businesses as if things will eventually get back to normal. They will eventually have the same type of earning power and likely more, just because we've got some hyperinflation on the horizon, but we won't talk about that in this video. So these earnings are likely going to go up. Cost of things is likely going to go up. So if you guys like this video, you guys like this mindset, make sure you give it a thumbs up and comment something down below. Let me know what shares you guys are watching or just what you thought of the video in general. I know this is a brief overview. This is not my in-depth view that I take of stocks, but I will do one of those later when I, have more interest in it. Right now, I don't have a ton of capital to deploy into the markets, but if I do see something that I feel like is a huge deal that I don't want to diversify as much, but I just say, look, this individual stock is on a massive sale, then I'll do a deeper dive on camera into that stock. But I've just got a lot of other things that I want to talk about, a lot of other things I want to focus on right now. So if you guys do want to see a deep dive into one of these companies, let me know though, and I'll do it anyway. So I hope you guys like this video, and I'll see you guys in the next one.